Guys, just looking at a quick question here from Matthew. Matthew's saying that he's trying to understand how the 25 basis point hike that was priced in already for the RBNZ last week, of course, how that could have been the case when, if we take a look at the Kiwi dollar, the pairs, even from the prior rate hike, it looks like the Kiwi dollar had been losing strength consistently. So how did we know that the markets were basically fully priced for a 25 basis point hike, despite the fact that the Kiwi has been pushing to the downside? So I think it's pretty much our fault here, Matthew, because sometimes we can use the same terminology, but we might be meaning something completely different. So what I mean by that is sometimes we'll say that the markets are pricing in something, but we might be looking at the currency and referring to pre-positioning going into an event, or we might be looking at the what's priced in terms of what the bond market is suggesting or what interest rate products and derivatives are suggesting. So, for example, referring to something that's priced in might not always refer to the actual price action for that relevant currency. Especially when it comes to interest rate decisions, we could be referring to the price action in the bond market, but we often refer to, I'd say most often when it comes to interest rate decisions, what we'll be referring to is the implied interest rate, the implied policy path based on interest rate derivatives, things like implied policy derivatives or OIS, the overnight index swaps, etc. So in the case of the Kiwi and that 25 basis point hike that we had last week, you are absolutely right to notice that the Kiwi didn't really trade like an asset that was pricing in a 25 basis point hike from the RBNZ. If we take a look at this, which is just the Kiwi dollar index versus the most of the majors, we can see that this yellow line, vertical line, basically highlights when we had the most recent meeting. And we can see running into that meeting, we just had a solid push to the downside. So not a market that was, or an asset at least, that was pricing in a 25 basis point hike. So what we were actually looking at was the OIS pricing. So if we just quickly take a look at this chart. So on this chart, you basically have the 1 month OIS, overnight index swap for the Kiwi dollar. In orange, you've got the 3 month in green, and you've got the 6 month in blue. Now, what you can see here is we had a very big push higher as the markets implied a higher policy path for the RBNZ. And what we can see with this yellow line here on the chart is that is actually the meeting date, once again, on the 24th. And what we can see is before the meeting on the 23rd, how markets were fully pricing in a 25 basis point hike. Actually, just a little bit more than a 25 basis point hike, because the OIS values were showing about 80, just above 80 basis points worth of tightening. So when you look at something like the OIS, always consider what your current cash rate or your current bank rate is for that particular central bank. So with the current OCR before the meeting, of course, at 0.5% or 50 basis points before the meeting, the markets, if you take a look at the 1 month implied OIS price, the markets were implying just over 30 basis points of tightening for that meeting. And what we saw, obviously, after the meeting, we saw both the 1 month as well as the 3 month push lower towards that 75 basis point level where the bank obviously hiked interest rates to. So we can oftentimes see how markets are pricing in things in various ways. But when it comes to the probability of whether a bank hikes, cuts, or leaves rates unchanged, that is mostly seen through either the bond market in terms of what the yields are showing us, or interest rate derivatives or STIRs, short-term interest rate products or derivatives like the OIS, or the equivalent of this could be something like the Fed Fund futures on the US side, SONIA futures on the UK side. And that's basically what we normally would be referring to when we say that whether a hike is priced in or or not priced in. So, for example, if we take a look at SONIA futures right now, you can see this yellow or orange line here resembles the December contract. And what we've done here is we've basically taken the SONIA contract, we've taken 100, subtracted by the SONIA to give us the implied policy path or the implied policy rate. And then we've also subtracted the current bank rate of 0.1%. So that shows us that right now, the SONIA Futures is pricing in only 12 basis points of tightening for the meeting next month. Now, remember, the markets are expecting them to hike by 15 basis points, which means that right now, SONIA Futures are actually not fully pricing in a hike of 15 basis points for the UK. So that's just a quick example of how you can use different types of products, different types of interest rate derivatives to show you the same thing. Now, if you have access to Icon, of course, you can access these different OIS pricing, which is very useful. But if you don't worry about it. We also have access to this inside the terminal. So if you open up the currency research section, and if you just scroll down to the interest rate probability tracker, if you open up any one of these central banks, you'll basically see the entire OIS curve, which is much more handy because that shows you how much implied tightening is the markets, or how much tightening is the markets implying over the next 12 months, which for me is a very useful thing to see what the markets exactly are expecting in the next 12 months, as opposed to maybe just the next month or the next 3 months, etc. A lot more valuable to see that implied policy path, if you will, instead of just the next meeting. So hope that helps with the question there, Matthew. As always, any other questions, please don't hesitate to let us know.